Name is Councilor Ken McCleary. This is the January 21st, 2025 Finance Committee meeting. I see we have our Deputy Finance Director, but I don't see our Chief Financial Officer / Director of Finance yet. And so, he's walking in as we speak. And so I'm going to call this meeting to order. I am present, the Deputy Mayor is present, Councilor Merritt is present, Councilor Lloyd is present, I see her online, and then Councilor Waterhouse is also in the building, but is going back and forth between two meetings, so I'm counting her present because she did check in. And I know she's in the next room. And so with that, we will turn it over to our Finance Director to provide us an update on the town reevaluation process.
Good evening, councilors, Finance Committee. Happy New Year. First time in 2025, that is. Thank you. In the printed materials, I reproduced the calendar showing that all of the reevaluation activities have been completed. The assessor is in the process of completing the reports that are required to be filed with the Office of Policy and Management with regard to the reevaluation. And what is remaining is the Board of Assessment Appeals work. Any resident or business property owner, be they residential or commercial, that wants to challenge their reevaluation must fill out the form provided by the Bloomfield Board of Assessment Appeals and file it with the BAA, the Board of Assessment Appeals, on or before February 20th. That's next month. Any applications received, the board will process through the balance of February and into March as necessary. And from experience, any appeals that may be challenged would be time consuming. Not something that would be resolved likely before the end of this fiscal year, but they tend to be resolved by the courts, which usually have a year or two tail on them. So the 2024 revaluation is complete except for the paperwork. And appreciate council's support through the process. It, of course, started long before I was here back in November, December of 2023. And the activities concluded at the end of last month, the end of calendar 24.
Thank you. Any questions from members of the committee? Councilor Merritt.
Much disaster they had as I just heard chairman here saying.
Make sure your mic is on.
Oh, okay. He wanted me to make sure everybody knew he is the most conservative Democrat in the world on budgeting. He wants to cut our expenses by 10%.
No.
Anyway, but I wonder, I have very strong memories of the 1990s, the early mid-1990s, when we had taxpayers associations running the town, and it was very uncomfortable to be on the town council. And I mean, it was very difficult and that was a direct result of a similar situation where we had a reval that shifted a lot of the tax burden onto the residential. And I'm wondering, how bad is that going to be? I don't know how you measure that exactly. I know my house value did not go up, so I went up the average, which was very nice from my point of view for taxes, but I wish my house were worth more. Anyway, but I heard other people had considerable increase in there, and some of them had figured out it was going to be a serious problem. So I just wonder how much of a problem we're going to have. Is the council all going to get fired because of this? Or?
I sure hope not.
Oh, okay.
I don't believe so. As I believe it was at the November meeting, presented a variety of analysis showing the approximately 43% increase in aggregate.
Yeah,
And then that
on the
bell-
average, yeah.
On average, and that bell curve,
Yeah.
the above and below, and some examples of the potential impact on an individual property owner.
Yeah.
With the most meaningful piece being the distinction between looking at the numbers in aggregate and total versus looking at an individual property. But in response to your question about the shift between residential and commercial, I believe it's just under 4% shifting from commercial to residential.
So that means you'll have, the average increase for residential would be something like 8%.
No, it's,
Or, I mean, for the total taxes of residential, because commercial is like half our tax base. So it would be, if they're going down 4%, that means that, and they had to make up that would be, have residential going up 4%, maybe, I don't know.
So looking at residential only, in total, the
Yeah.
increase is 53%. The commercial only increase is 32% in total.
3%.
You combine both the residential and commercial together, the total increase is the 43%.
Yeah,
So and that's looking at residential, commercial, and combined, the shift from commercial to residential is that 4%. 4% shift from commercial to residential. I believe it's 3.9
so,
something.
I mean, if our taxes were $100 million, which isn't too far off, is it? But I'm just using it as a round number. That means the amount paid by the residential sector will be going up $4 million and down, commercial down $4 million. Is that true?
No, not quite, Councilor Mayor. I think,
I mean, it's not $100 million, so it's, yeah.
so I think the shift, and Director Hill, let me know if I'm wrong. I think the shift talks about the percentage of growth, if I'm not mistaken, right? So the shift 4% means that commercial dropped 4% because it was at 27. Am I correct?
It grew at a lower
Oh,
amount.
yeah.
Residential grew at a rate higher than commercial grew by
So
about 4%.
Yes, by 4%.
that means 4%. If it was 50%, it's now 46% of our,
Commercial, yes, and 54 residential.
and residential is now 56% if it were, efficient, or whatever, 46. Anyway.
Yeah. Okay, my question, thank you. You done, Councilor Mayor?
Well, I'm still wondering how late can we decide to do phase-in? If we decide to do it, because being beaten up.
Councilor Romero, remember he said phase-in is kicking the can down the road.
I know it.
And then a lot of
I don't agree with that. I'm sorry. That means that we may get reelected. You don't care about that.
Oh, no, what I,
We would be lessening the impact on the residential by doing phase-in.
so
Quite a bit.
So what I will ask before we start budget, if it's okay with the committee, is for us to see scenarios of what it would cost
Yes, okay.
and
Well, we-
forecasting out.
So
right?
we
5 years.
we
All
can,
5 years.
5 years, all 5 years. So if we phase in,
Yeah.
we need to.
I understand all that.
Forecast out all 5
I've
years.
been through
Now,
all that.
granted, the forecast,
Okay.
right, is all projections and is scheduled to change based on the market and the economy, et cetera, right? We can't all, like, for example, we can't forecast to the T. It's not going to be perfect because we have external partners that.
Oh, obviously, we
you know,
have changes in
trash
the tax
collection
level. Yeah,
Contract.
sure.
We have
sure.
unionized contracts over the years that may think are going to come up and be a part of some of the negotiations in those 5 years.
Well, you're
budgets.
saying we can't assume that our tax level is going to be the same as it was this current year.
Yeah, or emergencies, right? Emergency may happen.
May happen, yeah. But I was asking, how late can we make that decision?
May.
Yeah, I believe it's when the budget is adopted and the mill rate
Okay,
is set.
So it isn't until next, yeah, okay. That's all I care about now.
Okay.
Perfect.
And
I see-
I'll confirm that.
So I see Council Lloyd, but before she go, I have a question, Director Hill. So usually in the budget, we put a certain percentage in our budget for appeals. So we we bake the number of appeals based on your informal hearings. Do you have a percentage of like, is it 2%, 3%, 1% that we're baking in for? As you said, most people are gonna go through the Board of Assessment Appeals. What percentage of the properties in the town do you think will go out? And what do you forecast that number to be for us to be prepared through litigation so that we can budget for that?
So I hear two things in that question. One is the value or the assessed value of the properties that are appealing, which we would address by reducing the assumed assessment value for the budget. I'll work with the assessor's office to see what our prior history has been and make the best educated guess that we can off of that. Of course, to be conservative, because while none of us want to generate more revenue than necessary to operate the town, it's a worse situation to not generate enough revenue. So in addition to our collection rate, which is normal in the budget process, I believe we're at 99.4 or 6. It's undulated
yep.
over the years in there. So one way is we can reduce our collection rate, or we can reduce the assessed value based on the what we will then know, right? Because the manager's proposed budget is after the application deadline for the Board of Assessment Appeals. We'll use that best information as our guide or gauge for what we should reduce the assessed value, be it residential or commercial, which will have baked into our 2026 budget an assumption for appeals, but also our collection rate.
I think we can, just to be safe, can we go back to the last 2 prior reassessments to see what the percentage was of, which one did we do? Did we do the excuse me, let me back up. To go back to the last and see what we did and make sure that we're being conservative to protect ourselves. That was my question related to that. Thank you. Councilor Lloyd.
Thank you. I'll be brief. I was just going to piggyback on CFO Hill's comment about the presentation in November for those residents who are concerned about what it means and what it looks like for their taxes potentially. The Finance Department did an excellent presentation producing scenarios that if you're a visual person, you're going to be able to understand it probably a little better than this conversation here. But it was a great presentation. It was made very understandable. And we also know what was discussed was equalization. And so while Councilor Merritt is talking about what does a phase-in look like, I don't think we're not talking about a property going from 200 assessed to 300 assessed and getting that same 38.5 or whatever mill rate applied to it. There's going to be an equalization formula that needs to be looked at so that we can still raise the funds that we need to run the town, as well as understanding these new higher property values. So I recommend anybody else who's listening, who has those questions, to go back and watch the presentation. It was excellent and very understandable.
Thank you, Councilor Lloyd. Deputy Mayor.
Thank you, Chair. My question was along the lines of the chair's in reference to the number of residents in commercial properties that will be appealing to the town. Do we have records? And I know it would be different because this is, every year is not the same. So my question is, you know, was there like the last time a standard percentage that we could anticipate our residents coming and appealing, and not to say what number would be successful in their attempt, but just trying to gauge, is this something, because we're getting a lot of feedback from the community and they want to find a way to reduce this. So the only option that we can convey really is to appeal or to go through the process. And I'm just wondering, how successful have we been in the past with managing that and then still meeting the numbers that we need at the end of it.
And I'll work with Assessor Midadzi to look back at the last 2 or 3 revaluations and the number of appeals received after each. From the informal hearings, I don't want to quote a number. I have in my head that it was around 40 or 50 people came in with questions about their revaluation. Most were seeking understanding of the components that led to the revaluation. I won't stand here and say that there were none that had successfully demonstrated or provided information to support that their revaluation should be something different. But I do believe that if there are those that went through the informal hearing process that were encouraged, that they had information that would support a different revaluation, that they will appeal. The crystal ball for success, who knows? It depends on what information is provided, but knowing how robust the process was, not only from the assessor's office, but from the vendor's office, and all of the quantitative analysis that was utilized to arrive at the revaluation. And in addition, that the revaluation wasn't seeking to have our 2024 revaluation get to 100% of market. The target is somewhere between 93 and I believe 98% of market. So we err on the low side, which helps with from the administration's perspective, with the informal and formal appeals that may or may not come.
Thank you for that. Final thing, because I am seriously concerned about, we talk about equalization of the 43%, but there are certain people who property went over the 43%. And so then inherently, although you have the equalization, I think this is where Councilor Merritt is talking about, although you have the equalization, if your house grew 45 to 50 to 60 to 70 to 100 to 120% more than what it was previously, you're automatically going to get a increase in your taxes. And what do we do? Hence why we have mill rate stabilization policy on the agenda tonight. But what do we do and how do we mitigate the perception of those people who already feel like they're overly tax burdened? How do we mitigate and support them through this process? I haven't heard any creative ways outside of the equalization, but I would love to hear from you if you have any or have seen anything from your colleagues across the state on how they have mitigated the people who are above the mitigation, well, the equalization number and growth.
It's a difficult question because embedded in the question is a philosophy that's contrary to what the revaluation is, right? The revaluation is, as required by state law, every 5 years. In the securities or the financial sector, we call it mark to market, right? So every 5 years, we bring everyone up, all properties in the town, up to what market is for that 14 months, 13 months or so that the revaluation is going on. And then in the intervening annual budgets, there is an estimated growth, right? So the mark to market every 5 years wipes away the prior 4 years estimates and says, this is market. So in the question that is asking how to have the market arrive at a different value, I'm not aware of any creative ways to reduce what is market value.
Yes, good.
I was going to say, the problem here is that houses have gone up in their market price. The market has grown up, sometimes doubled the value of a house in the last 5 years, double. So that, therefore, the assessment would probably double. And that can cause, that may cause the taxes to go up quite a bit. And so So but people don't seem to care. They're very happy the value of their house is going up, but they're not selling it. So they'd rather not pay the taxes on that. And the other problem you're going to have is businesses are going to say, wait a minute, the value of where the library is right now, that building, that's going to plummet it. And the market value of that is going way down. And I know with businesses, you do use different ways of doing it, not just market, but still, it basically does reflect the market. And they may not be happy with how much their taxes are reduced. So you've got two groups that are going to probably be knocking on the door. And I had a 40,000 square foot factory that I was paying taxes on in Weathersfield. And I ended up suing the town. After I did the appeal, and that didn't yield much. And so I sued the town, and that proved that indeed the value had gone way down, and the market was unjustified, and it saved me an awful lot of taxes. So you're gonna find some businesses trying to do that. And so it could be a tough year. But we'll have to see.
Sure.
I think the phase-in is one way you can react. That I know you don't like it, but we may all want to do it next year. So
Director Hill, also, when you do the forecast of the phasing in, can you also provide to the committee how many other communities who've been through this process and seen their values go up, similar to Bloomfield, have done the phasing process, so that we have kind of like a starting point as to what other communities are doing? And if we see that other communities are doing it, then it makes sense. But if we see that other communities aren't doing it and they have the growth that and property values that we are seeing, then that begs the question, should we be doing it? Because I'm of the philosophy that it kicks the can down the road, because you got inherent on top. If you phase it in next year, you got all contractual obligations next year on top of the phasing for this year, and then vice versa, the same thing. And it's like compounded because of the value of $1, et cetera. And so we just have to be very careful. And tell me if I'm wrong, Director Hill, in my approach, but you have to be very careful with those things. And I'm sure other town councils, if we're here or not, would not appreciate us kicking the can down the road and locking them in those budget years. So just my thoughts.
Sure, I do, having taken a quick look at the relevant statutes, any community that chooses to phase in at any year can cancel the phase in.
yeah, they don't have to do it each of the 5 years.
Right. But the statute does prescribe, I think, 2 methods by which we could phase in. When you asked the question about other communities in the state that are phasing in, I chuckled a little bit, because in my head, I thought if I can provide that information that demonstrates that there are no other communities in Connecticut phasing in, do I have to do all the work to evaluate it for us?
I would leave that to the
I'm
good
joking.
minority,
I'm going to do the work.
minority party Representative Councilor Merritt to see.
Regardless of what other communities across Connecticut or across the country are doing, I shouldn't joke, right? We'll do the work, right? So that we have it and it'll be on the shelf. And while different revals have different dynamics, the analysis of the phase-in should stand. So whenever the town did it last, if there was analysis, that analysis should still hold. But I've not seen that and would rather undertake it myself, even though it's adding to a
Long list.
challenging list.
So I won't
Challenging
spend too much
time
time on it
constraint list.
until we have to. So
Yes.
Okay, is there any additional questions from members of the committee? I see Councilor Cooper online. Councilor Lloyd, are you good? Perfect, thank you. Hopefully,
And Councilor Lloyd, thank you very much for the kind words about the reval presentation from November.
yeah,
I appreciate you, all of you, but especially Councilor Lloyd.
thanks. Hopefully, every member feels like they had the ability to communicate and get their questions answered from the finance director in
There
this
you go.
discussion. Good, thank you.
Thank you.
Thank you. The next item on the agenda is an update on the FY '24 audit.
Whew. It's ongoing. We are, next week, 2 days, the auditors will be on site, for the first time, for the audit of fiscal '24. We are getting much closer day by day with finishing the bank reconciliations, for fiscal '24. I earlier today submitted our request to OPM to extend our filing deadline from January 31st to February 28th. I mentioned that, I think, at the November meeting. We're still optimistic that we'll be able to hit that date, but given competing workload, competing workload, primarily the budget, I'm not optimistic at this point that we will be able to hit February 28th. I do believe it will be into March. This is a symptom of once you get off track, it's hard to get back on. We should not be in audit and budget at the same time. They should bump up against each other. Audit's done in December and the budget spends up in December. We are still finishing '24's work. So I stand on my belief that we're not really auditing '24 yet, right? Because the work for '24 still isn't done. I believe that that happened because, like last year, the focus was on the audit, then budget rolled around, audit got put aside, budget was achieved, and then, as we know, July of '24, the audit was completed. Couple of months after the budget was done. We're looking to compress that. It won't be July, it won't be June, won't be May. I feel really good about March. And that would shave 3 or 4 months off of, I believe, the prior 3 years audit submission.
Any questions for members of the committee?
One last thing I will share, was brought to my attention last week when we were pricing our bonds, which that update is coming up. I do not say this in any way, shape, or form as an excuse, or whatever adjective, folks come up with, but there are communities in Connecticut, highly regarded, financially well off, that are still working to finish their '22 audit and their '23 audit downstate, right? AAA rated communities. We're AA plus, one notch under them. And their ratings are on the watch list because they're 2 years behind on their financials. So while in Bloomfield, we've been late for several years in filing our audit, and as I stand here in the middle of January and we haven't filed, we're late this year. The work of Ms. Stewart to get through fiscal '24's work and how we're approaching '25, not only the budget development for '26, the completion of the fiscal '24 audit, but the preparation for the '25 audit. The '25 audit will be orderly. We will get to the fourth quarter. We will issue right before the fourth quarter our fiscal year end close memo, which will be the start of the audit process. And as we get through the summer and into the fall, the auditors will be here reviewing fiscal '25, and we will meet the December 31 filing deadline this year.
Well, hopefully that would be good.
It's not a hopefully, it's something we're going to do.
Whether I'm here or not, that was that has been my goal over the last 3 years since I have been the chair of this committee, to make sure that we get back on track. And I say at every meeting, is there any additional supports that you need so that we can make sure that we get on track? Because although you say other communities are 2 years behind, I want us to be I want us to be the model of other communities. And I'm not criticizing you or Donna about not getting the audit done. You're doing yeoman's work. The finance department was in shambles. and we finally got good leadership in there, and I trust this leadership that's in there. But the public, the audit is so that the public understands where we stand with our assets, our liabilities, and everything else. And it's the clearest picture that they have to know that we are being good stewards of their dollars. And so I am going to be a little on this. I know the manager is going to say his team is doing great work. But if there's anything that we can do to make sure that, I know the auditors are on board, that we can get it as close as possible to February and not go into March, I would greatly appreciate it, because that would be a huge improvement year over year over year. So those are my comments, and I appreciate the work that you and Donna are doing along with your team and the town managers. With his support, you guys are doing great work, but it's very important for the public to understand and see that the audit.
Sure, and, OPM's extension requests, they asked that 10 days be allowed for processing, which is 10 days before the end of the month. So with the timing of next month's meeting, I believe it's on the 17th, which will be just inside the 10 days, which is just under a month from now. I, of course, will know at that point whether or not we're going to meet the February deadline. And we'll be able to speak more definitively about where we are. And if we're not able to meet the February 28th deadline, you'll hear greater certainty about March. And it won't be, it's not as though the end of the month filing deadline is what we're shooting for. We're shooting to get it done as soon as possible. So while at this point, I believe we are not likely to make February 28th, it may be the second week of March or something along those lines. Again, I'm looking at it not only for the completion of the work of our predecessors, but also how it impacts our ability going forward to break the cycle of being late.
Yeah, I agree. And it also gives the council good, clear picture as we move into budget, where our fund balance
Amen.
is
Yeah.
and other revenues for, it's just, we are going to go into another budget blind, not knowing where our fund balance truly stands, having estimates. Everything is an estimate except the audit, because the audit is the.
We get through February and are successful at filing our fiscal 24 audit with the state by the end of March. We will know for the budget deliberations. We won't know for the manager's proposed budget, but we will for the council deliberations in advance of the town meeting by a month or more.
Thank you. Councilor Lloyd, you have the floor.
Thank you. You stole my thunder because you said most of it. You and CFO Hill, you basically said it. Thank you for sharing the information regarding other more wealthy communities who are not even doing as well as we are. So I do give kudos and compliment to the great work that is done with our new staff. There were some disconnects, right? But things were getting done before, but now they're just getting done to a much higher level. So the public definitely needs to know that we're light years ahead of where we were last year. So that needs to be acknowledged. And with you guys tracking the way you are, I definitely see us getting caught up as it relates to the audit work and when it's due and meeting deadlines. So I feel confident in that, thanks to the work of the new staff. And as well, Councilor McCleary, to your credit, because you kept pushing. You kept pushing, you kept pushing, you kept asking the right questions. And now here we are in a much better place than we were a year ago this time. So kudos to all of Team Bloomfield. I just really appreciate you guys as a resident of the town for the continued work you do. So good job, everybody.
Town manager?
Yeah, good evening, team, good evening, citizens of Bloomfield and council, thank you for the time. And thank you, CFO Hill, for your presentation, which I know is continuing. And Councilor McCleary, you're spot on. I'm gonna come in here and tell you that the team is doing the best they can. And one thing that they're doing as well is learning through this process. So I know you have a very generously offered resources to help us. I know resources have been provided in the past, but we have it. We have it. And there's a learning process that is taking place to make certain that we are positioned for success moving forward from this point forward. So I just ask for your continued patience and understanding. And because if we were not situated for success, I'll be the first one saying that's not going to happen, or this is what I anticipate happening. But that's not what I'm hearing. That's not what I'm understanding. So when I tell you that we're working, that is the truth. And I sort of make the analogy of from some military experiences, right? And it could be a ruck march, 20-mile force ruck march with 100 pounds on your back, or it could be one of those runs that we love to take in the Army, calling cadence for upwards of 7-10 miles. And just when you think we're about to finish, well, here comes another mile, here comes another lap, here comes another 5 miles. And you just have to keep reacting to what's in front of you. And that's what our finance team is doing as they think that they are at a point of meeting success. Here comes another awareness of a challenge that was unanticipated. And now we have to go back and address that issue before we can move forward. And unfortunately, and I'm not here to cast shade on anyone who was trying their best with the capacities that they had in the past. But the reality is this is where we are now. And it seems like we don't go more than a few days without hearing, well, you got another lap, you got another mile, you got to stay in the race, you got to stay on that ruck march. And that's what we're facing. This target is moving. And because it's moving, it's very hard to sort of capture that end state. Although we know what we want it to be. Trust me, if we could have been there yesterday, we would have been there yesterday. But these challenges keep presenting themselves and they cannot be ignored. So I just ask for everyone's understanding. This is not about excuses. We don't make excuses. We provide explanations as to what's occurring so there can be an understanding of what we're facing. And the last thing I would want it to be is appearing as if we don't own it, because we own this. We own this audit, we own this budget, and we don't look in the back to say it's somebody else's problem. We're just saying this is what we're addressing right now. So I just hope that there's an appreciation for our situation, and trust me, as soon as we can make it happen, we will. Only funding I would need is for a time machine to get the Daryl and Donna in the town of Bloomfield, maybe about 10 years ago. And I know we can't afford that. So, but short of that, and I make light of it just to bring a little humor. Short of that, I just say we're working, and we understand the mission, and we're committed to it, and we're putting a lot of hours into that desired end state. But when it changes, we just have to react to that. And unfortunately, you just don't know what that next stone is what's gonna be under that next stone when you pick it up. But whatever it is, we have to deal with it, and that's what we're doing. So I just hope that provides some understanding of what we're doing, and yet through all of this, there may be some thoughts that the AA plus was just a continuation of the path. I'm here to say it's not a continuation. It's through the diligent efforts of those who are a part of this command team, that are part of this finance team, a part of our council that allows us to be at AA plus. Because if you look to your left and right, there's communities right next door that did not maintain their rating. So for anyone to believe that this is just a gimme and you're just continuing par for the course, no, it was earned under some under a lot of duress. And I'm proud of the team, and I'm proud of all the people I consider colleagues and part of Team Bloomfield to make that happen. So thank you for the time to speak. I'll shut it down now.
Thank you, Mr. Town. Thank you, Mr. Town Manager. Any other questions from members of the committee related to this action item? If not, we'll move on now to the discussion and status, a perfect segue, Mr. Town Manager, and provide an update, Mr. Hill, on the recent bond sale. Maybe if you can present the screen just so that the public is aware of what we just did. It's a community.
Yes, last Tuesday morning, the town received bids for its refinancing of the bond anticipation notes issued in January of 2024.
Quick question, sorry to interrupt. Can you start back from when you did the analyst came in and
Sure.
go the whole process and let the public understand the process in which was just undertaken? I think it will be helpful.
Sure. So again, in January of 2024, the town issued long-term bonds, but also short-term notes. The short-term notes are what we're discussing this evening. The total amount of the bond anticipation notes issued in January of 24 was 17.25 million. The maturity date for those bond anticipation notes is January 28th, next Tuesday. So to refinance our bond anticipation notes and issue long-term bonds, that's a completely new public offering, similar to the town, to what the town undertook last January. And in that process, we work with the town's financial advisor, Barry Benarby at Phoenix Advisors, our bond counsel for the bond documents, and the rating agencies. We had a schedule developed over a 2-month period beginning in late October, preparing to update the official statement or the preliminary official statement for the bond pricing. That and other documents related to the transaction were shared with Standard & Poor's Global Ratings. They rated our bond issue last year, went through the same process where we provide information about the town, generally and more specifically about the town's finances, all of the documents, including the preliminary official statement for the bond issue. And then we meet with the rating agency. The rating agency at that time, after having reviewed all the information provided, they ask a long list of questions. I believe this year there were, I don't know, a dozen and a half, maybe 2, about the information provided or just general information that they ask every local government that they rate. That is also that Standard & Poor's can develop its own independent opinion of the town of Bloomfield. That independent opinion isn't necessarily for Bloomfield. The rating agencies, S&P included, along with Moody's and Fitch, but for us, S&P in this bond issue, they're forming an opinion. That opinion is what investors or potential investors utilize when they're making decisions about whether or not they want to buy the town's bonds. The most critical component of that is the independent review, right? Having been a former governmental investment banker back in the 90s and 2000s, I know that prior to my starting in banking, I caught the tail end of it. There was a rating agency, not S&P, that was coming out of a bit of a scandal where it was viewed that issuers could purchase a rating. That is the complete opposite of an independent opinion. It took that rating agency better part of a decade, upwards of a decade and a half, to fix their reputation. So I mention that because Standard & Poor's opinion of the town of Bloomfield is what's led to the successful pricing that we had last week. So as the manager said, well, you know, each issuance and annually, they do annual surveillance if we don't issue bonds, is S&P's independent opinion of the town of Bloomfield. They answer to no one. They answer to themselves. They have a very robust methodology with regard to how they rate local government in the United States. They do metrics so that communities can compare themselves to others. That's challenging because each state is different. Population sizes are different. I mean, we're AA rated and there are AA rated cities across the country that have over 1 million people, right? There are AA rated communities that have half the population of Bloomfield. So that rating methodology is really key so that it provides a consistent standard with regard to how this rating agency develops their independent opinion. Moody's has their methodology. They're all slightly different based on their the firm's methodology or philosophy with regard to how not only you rate local governments in the United States, but how those ratings relate to state governments in the United States. But again, that Standard & Poor's Global Ratings rating methodology, I would refer anyone who believes that it's just a continuation of the past to take a glance at it. It's not an easy read because it is heavily into the quantitative analysis of local governments' governance and financial performance. So when Standard & Poor's affirmed our AA plus long-term rating, they also affirmed our short-term rating at SP1 plus. SP is Standard & Poor's. The SP1 plus is Standard & Poor's highest short-term rating, which said very succinctly means that we don't have liquidity issues, right? There's no short-term concern. So based on the updating of the preliminary official statement for where the town stands as of the date, which is, I believe, the first week of January 25, we updated the documents from last year to this year and provided those broadly to the broker dealers, the underwriters that could or would be interested in submitting a bid to purchase our bonds. We're not actually buying something from them, they're buying our bonds, so they're buying something from us. The result was that the town received 10 bids. And if anyone that's familiar with procurement and competition, a robust competition starts at 3. 5 is even better. We achieved double digits. And as is shown on the screen, the low bidder was UBS Financial Services, Inc., with a true interest cost of just under 3.6%. That true interest cost is a total look at the cost to the town of these bonds, not the principal, the 17.25 million, but when you take out all of the mathematics related to the bond market, that 3.587 is a blended rate that we will pay on these bonds. There's actually a scale of interest rates with a different rate attached to each year's bonds maturing. You add all those together, you look at the interest, you add in the cost of issuance, and you arrive at that 3.587. The 3.587, as you can see, the cover bid was a full 3 basis points higher, 3.61. But in the first 3 bids, even 4 at 3.62, very strong competition. And not until you get down to 6.8, the 9th bid is there 10 basis points spread between our top 9 bidders. So from a pricing perspective, a 3% interest rate is very good. It's not as low as it's been. You know, there were folks issuing bonds during the pandemic that had a 1 in the front. When I started in the business, there were 5s in the front, occasional 6. And it's, as the markets are always moving, we were lucky to be in a market where the inverse relationship between the stock market and the municipal market was to our benefit. There was a little bit of turmoil with the Fed taking actions to reduce interest rates, but the stock market not doing what the Fed anticipated. That's all good news for us. So now we want the stock market to turn around and do better for the economy's sake, since we've priced our bonds. So with UBS as our winning underwriter, again, at that 3.587%. We are preparing this week to close the transaction. We're gonna have pre-closing this Friday with the formal closing Monday morning. That's when wires will be sent, receipt confirmed, and the bonds released. And then on the morning of Tuesday, January 28th, our trustee, U.S. Bank, will make the final payment of principal and interest on the bond anticipation notes, and they will no longer exist.
Any questions thank you for the update, Mr. Hill, really appreciate that. Counselor Merritt.
I wonder where we are on whether we ending up going to bond something around $30 million?
Of bonds outstanding?
No, new bonds for the library.
Yeah, it's 34.
How much of that have we already, when you include this, January's increase, how much of that is now been borrowed?
It's all been borrowed.
All of it?
Yes.
So this is
Last January, there were two pieces to the transaction. I believe it was 17 million of long-term bonds and 17.25 million of the bond anticipation
Oh,
notes.
okay, so that pretty much covered the whole thing.
Right. These bond anticipation notes are what we're refinancing now long-term. So we'll,
So it's 100% bonds,
as of next Tuesday, yes.
okay, and that they're 20-year bonds?
Yes,
And so we pay 1/20th every year of the principal.
correct.
Interest, so it's a big heap up front, but it gradually goes down as there's less interest.
Yes, we have a 20-year final maturity. Given the timing of this transaction, instead of making it a 21-year final maturity, we held the 20 years as the final maturity, but we deferred the first year of principal
Okay,
to lessen the budget impact in 26.
okay.
And in addition to the bond premium, right?
And yes, there was roughly 900,000 of bond premium generated from last week's transaction. The IRS allows us to utilize that bond premium for a couple of pretty narrow things. The most significant of which is what we'll use them for, which is to pay cost of issuance and to pay interest. We cannot pay principal with the premium. So as in fiscal 26, 27, and any remaining premium from this transaction, we will use to shave the peaks off of the increase in debt service. So it won't go as high, right? And with the analysis from our financial advisor, we're anticipating being able to keep our debt service with the use of that premium to repay interest in fiscal 26 and 27, that our debt service will not go above 8 million.
Oh, but this coming year will be the highest debt service year, is that?
So before the refinancing of the bands, right? Because in January of 25, they were issued as short-term obligations. The principal wouldn't show in the debt service, only the interest would show.
Okay.
And yes, 25 would be our highest at what looks to be about 7.2 or 7.3 million. This refinancing is adding about 1.3 million in the first year, really the second year because of the deferred principal, which would push our peak up in 27 to about 8.2 or 8.3 million.
Oh,
But that use of premium, about 900,000, we're going to pay our cost of issuance. We're going to buy down some interest in 26 to stay below 8 million, as well as 27 to stay below 8 million. And as you pointed out, well, Councilor Merritt, in Connecticut, we're required to issue level principal. So the principal amount maturing each year is the same or no more than $5,000 difference. That's one bond is $5,000. So we're paying essentially the same principal every year, but as we work our way down the repayment schedule, the interest decreases, which is why the payment decreases. The principal is essentially the same every year. The interest is declining, which is why looking just 1, 2, 3, 4, 5 years out, the premium is fully exhausted and our new debt service is back to where this year's debt service is. That's 7.2 million. And then it continues to decline. The philosophy behind a conservative level principal approach to repayment is that it's financially responsible, it's financially conservative, and while you have a higher payment in the early years instead of a lower payment and level debt service payment throughout the 20-year repayment. With level principal, that declining repayment schedule builds capacity for new issues without debt service going up. For places that allow level debt service, you do a bond issue like ours, and your debt service is at not 1.3 million in the first year, it's say at 800,000 in the first year, but then it's 800,000 every year. So then when we issue new debt, whenever that is in the future, it gets laid on top of that 800,000. So now debt service is higher for the next 20 years or until that first issue gets paid off. With level principal, and the graphic for you, the decline, we can backfill and still never get back up to our peak, depending on how frequently we issue and how much we issue.
Is it possible we could have a update of the chart that shows our debt service level over time, so we see when these peaks are?
Sure.
I'm sure you're doing everything you can to push out the peaks, but be nice for us budgeting reasons to be aware of that, because it's gonna make things tough.
Sure, I can put that on the list for next month's meeting.
Yes, and also let us know where we are as it relates to our 10% debt policy, which I think we're approaching about $2 million.
I think the policy says not the debt service not to exceed 8 to 10% of the annual budget.
Yep.
So with a $110 million budget, I don't think it spoke to any reductions in the budget. And I mention that because sometimes there's a little caveat that says the tax generated budget, right, which is around 90 million. The policy says 8 to 10%. So not to exceed 10, and we're working to stay below 8. So we'll be well within our policy.
And in that decision that the council made not to exceed that is also looked at by
Absolutely.
S&P, right? Because it's financial management of the town and the fiscal health. Rory, just want to make sure that.
Sure. One of the things that S&P pointed out in their write-up, and I believe their reports are publicly available, was the existence, not only the existence of financial policies with regard to reserves, with regard to debt service, but adherence to them, right? So it's not just that we have them, it's that we follow them. And that's something that they cite, how do they say it, very crafty wording, downward pressure on the rating would be non-compliance with our policies.
Got it, thank you. Any additional questions? I think this was really good for the public to see that we are working and that the decisions that we are making are affecting them. And it's not just this portion of borrowing, it's not just for Wall Street, that it's just for everyday Bloomfield residents, because it does impact our bottom line and our budget, i.e. the debt service payment that
Sure.
we have to put in our budget every year. It affects them.
And thank you for that prompt, Counselor. That's one thing I didn't mention, right? So we're AA plus. We have a very strong investment grade rating. The only rating above us is AAA. One of the things I've asked our financial advisor, and I expect to have for next month's meeting, is some analysis that shows how we priced last week compared to AAA. I believe there was only one other transaction in the market last week in Connecticut. But looking at other AAs, be they in Connecticut, neighboring states, or Northeast, East Coast, nationwide, to see how they price. But there is a scale. It's the benchmark that the municipal market uses to base interest rates off of.
Richfield.
I know it as the Richfield. I know it as the MMD index, which is just AAA rates. But they show AAA rates, and then based on the strength of a credit, right? They're looking at our S&P write-up and the investor's opinion about S&P's opinion of the town. They look at the town and they develop their own opinion and say, do I want these bonds, right? You think about whether it's a trust fund, not a trust fund, an investment fund, or even smaller mom and pop investors. But for the funds, the larger investors, they have a $3 billion portfolio, and there's something that matured last week. and they need to fill a hole. So they're not only looking for credit quality, but they're also looking for the magnitude of the dollars for the hole that they have to fill. So with our $17.25 million transaction with a very strong investment grade rating, our bonds are very desirable. While the quantity isn't as much as some would like, it's what we had to offer. And when they can find highly rated AA plus
Good
paper,
Good paper.
they really want it, which I think is why our rates are lower. Now, if we were AA or AA minus or A plus or A minus, that 3.587 would be higher. So there is a direct benefit to anyone who's interested in the town of Bloomfield of being so highly rated.
Thank you for that, because I think I drafted a letter to the editor this week explaining this process a little bit. And in my research, given where I work and can see all of the reports of borrowing across the state, because it's public, we just got, I think it was 5 basis points higher than I think it's Richfield, Connecticut, who has a AAA rating. So that tells me that the market is treating our paper, borrowing paper, just as well as they're treating a AAA plus,
AAA, no plus.
AAA, excuse me, not plus, AAA community. And so to articulate, and I know we're getting in the weeds and we should be focusing on residents, I want residents to know that this is a win for you because we are being fiscally responsible. We are managing the town. You may disagree with some of the decisions we make up here, but we're doing it with the focus on making sure that we ease the burden and find savings across our budget. And I think this credit rating here and this borrowing of 17.5 helps ensure us that we didn't add a significant burden unnecessarily on our residents as it relates to the debt service. And so I'm going to stop there and ask one question related to maybe next month, the financial advisor could come in and do a presentation on some of the things that we can do as a committee to move us up to the AAA. I know I've spoken to him previously, like maybe 2-3 years ago, and he mentioned to me offline when he came about it being about demographics of a community and not necessarily racial demographics, but socioeconomics, et cetera. And that's what's stopping us from moving from the AA plus to the AAA. But for him to come back and do it in front of this committee so that residents know that this body and the council is doing everything we can to try to elevate us to become a AAA plus. But sometimes the market and the economy is out of our hands and we can't directly impact that. And so if he can just come next month and do a presentation.
Sure.
So that Councilor Mara and this body and the public can hear from him. Any additional questions related to this topic? Town manager?
Yeah, thank you. Thank you. I just want to make certain, and I know this won't be a heavy lift for our CFO, but all our efforts and all our focus right now are on 2 things, right? Budget, audit. Audit, budget, right? And anything that gets in the way of that is a challenge right now for us. So I do understand the ask in this is of the consultant, but I just want to make sure we stay laser focused because we don't have a lot of time. And anything that takes away from that focus, it keeps us off mission. So I just want to make sure as we talk these things that we understand our primary focus has to remain constant.
Thank you. Point well noted. Moving to the next item, discussion and status update regarding financial policies. This is an item that I'm just going to keep on the agenda. We talked about it at the last finance committee meeting about the mill rate stabilization policy. I call it like fiscal guardrails, i.e. the state and economic development trust fund to promote economic development across the town. What we can do right now, we had like 22% fund balance, and if it continues to grow, it makes no sense to just keep putting that in our emergency fund because it is used for emergency funds. And so if we start to create these other trust funds and special revenue funds similar to our savings account, when we hit a certain number of percentage, 1%, 2% over can go into these funds to promote economic development. If future councils get into a pickle with revow and looking for extra funds to mitigate these are one-time funds. And I wanted to create some type of structure around the usage of them, like how we have our debt policy, how we have our fund balance policy, to create something so that if we get to 28% of our fund balance and we have an extra 10 million, maybe we don't put it into fund balance, maybe we put it 2 million into economic development, 1 million into mill rate stabilization, to start growing those things, because fund balance, and I read through the rating, some concerns about the 2.75 million that we keep putting in as a buffer to stabilize the mill rate stabilization, to stabilize taxes. We might as well just create a mill rate stabilization policy to do that in case those years come along, because I know the analysts from the rating agencies kind of frown upon that when you keep putting that one-time revenue in your budget. And so this is on here, not to tell you to do it right now, because I heard the town manager, budget audit, but at some point, if we can start to develop in some policies around these initiatives, I think it would be good. Same thing with town council contingency. Every year, we're looking for things to not roll over. So if the town council contingency could be a special revenue fund and roll over year to year, so that the council's contingency starts to build a nest egg for other things that deem appropriate. Maybe it's an extra position for the town manager, education, summer school came up, et cetera, so that we can continue to support the great things that the residents of Bloomfield ask for. Hopefully that makes sense to members of the committee. It's trying to create some guidelines and some long-term vision and planning for this body and future bodies.
Yeah, I think it's great. I mean, and the town has already taken 2 very good steps with the fund balance policy and the debt service policy. And in both of those, you'll see some things that are typical for local government financial policies. They're not hard and fast. We're going to have this at this percentage. We tend to put a range. And as we add more policies to our suite of financial policy guidelines, one of the things that we'll do, and I'll say in the coming months, really meaning a couple of months from now, after we get the audit done, we'll be looking at not only these, but potentially others. And, it's multifaceted. It's not, what's the level that any of the new policies should be at. It's a range, right? So that the council has some flexibility and it's not hard and fast. And also includes a component for how the town would replenish if we utilized, right? Not every policy needs to have that replenishment process spelled out. But depending on the policy itself, and I think this lends itself more to our fund balance policy, right? If we were to find ourselves with our fund balance falling below our policy should have a replenishment process. In the conversation about what's needed, what the town could do to try and influence the opinion and achieve the AAA rating, that replenishment is important. Not falling below is important. Having multiple buckets is important, because one of the consistent things you see from AAA communities, similar to Bloomfield, ours isn't large enough yet, is very healthy reserves, right? We have healthy reserves, but our healthy reserves in the magnitude, or compared to the magnitude of our budget, they're not that healthy, right? So even at the 20% or 22 or 24% level, I could put some numbers out there and suggest that, we'd need to be at 30 or 35% reserves to be in that AAA category, because, and that's only looking at one piece. That's why my remarks earlier about the methodology at Standard & Poor's is important. that methodology, they kind of chunk it out. Your rating is based on, 25% of this, 25% is this, 20% is this, 25% is this, and 5% is this. You add them all up, and based on their methodology, it's going to suggest a rating. But it's not that hard and fast where if you hit this number and hit this number, you're going to be this. They use those as guidelines for their own rating methodology, and then they give it independent thought and look at what's going on in the community, what the history has been, how strong the management is, what the reserve levels not only are, but have been, and are we maintaining those levels? So there's no silver bullet, for lack of a better word, but rather a very methodical approach over a number of years to achieve a rating upgrade. Not to AAA, any rating upgrade, right? It just doesn't happen quickly. It's a very slow and deliberate course of action.
Quick question. Thank you for that explanation. So our current policy that says 15%, is it? Yeah, it's 15%, right?
For fund balance, yes.
Yes. That was
15 to
15%.
20, yeah.
That was 15% of whenever it was adopted, right? I think it was like 90 million or $96 million at the time that was adopted.
I believe it's 15 to 20% of the current budget. So as our budget increases every year.
That's my question.
need to
Should we
add
be
to-
moving that 15% up a little bit, given that our budget, I think when we adopted it was in like the low 90 million dollar range, and now we're approaching 100 to 110 million dollars. Should we move that number up, or is it fine to say 15% of 110 million dollars?
I mean, I think it's our policy now. My view of it, and I'll, because I can still, use my newness to the town, but I think we leave it where it is and consistently outperform. The conversation about adding to our financial policy guidelines is going to have monies that would be sitting in our unassigned fund balance, the rainy day fund, that will get moved elsewhere. So we'll be focused on making sure that our unassigned fund balance, our rainy day fund, continues to maintain policy, even with the growing next budget, because those dollars, unless they grow, will decline over time. So we're gonna have to add to our unassigned fund balance on an annual basis just to maintain 15%.
So that's my goal. My goal is to do, like, if we have $10 million, to still put a percentage, no matter what, whether we're at 22%, 28%, put a percentage of that $10 million in fund balance, but don't put the whole $10 million in, start breaking up the pieces and say maybe 8% of the $10 million goes into, or whatever the number is. I'm just throwing out a number. It's not the solid number. I just want to be very clear. This is just an example. It is not actual number. But if it's between 8 to 10% goes into fund balance, but then you put another 10% here, 30% here, 40% here, it would make up here. You would still, to your point, you would still have to add to the fund balance to keep up, but you just don't put the whole $10 million in.
Sure.
Yeah, I wanted to say something about OPEB, because we struggled to get
Well, let's
the
decrease it.
program going. And I think it wasn't a very aggressive program, but putting money into funding OPEB ends up saving us more over the long run. And I just wonder how we're doing on that. Are we observing that, or is that?
Yes, we are.
Are we catching up, or are we?
We are on our plan. We
That
developed
wasn't
a
a very
plan.
aggressive plan.
We developed a plan and we're working that plan
Yeah.
So they call it the ADEC, the Actuarially Determined Employer Contribution. It's a number, and to make the math easy, I'll say it's $10. And the town got on a plan that said, okay, well, we can't afford $10 right now, but we can afford $5. And so we'll pay $5 this year, and next year we'll pay $6, and the year after we'll pay $7, and the year after we'll pay $8, and we'll get to the ADEC. And that's what we're doing. So in, I think, 2 years, it might be 3, don't quote me, we will be at funding the ADEC. And that ADEC is actuarially determined to, over a period of either 20 or 30 years, I'm not sure what it is here, to get to 100%.
isn't that a little too modest? Do you find it? I mean, wouldn't we save
It's-
us money? Okay, I will.
No.
I just,
5 months I've been here. I love answering this question. I've answered it for over 20 years, both as a financial advisor in the Mid-Atlantic and as staff at a number of places. Whether it's OPEB or pensions, right? We are not a private corporation. We're not going out of business, right? So I believe that our target should not be 100%.
okay.
I believe our target should be, there's lots of debate and there's some research out there about what would be an appropriate level below 100% for government, local government, state government. We're not going anywhere. It's not as though we could decide to close the doors or sell the business and then play some funny games with folks' pensions, right? We are
Doesn't it cost us more, though, to be well below 100% than if we were 100%?
cost us more for the benefit, for the other post-employment benefits. I think the cost is the cost. So no, it doesn't cost us more. I'll maybe incorrectly assume that your question is more speaking to the rating agencies. Yes, high unfunded long-term liabilities push ratings down, which push debt service up, which cost us more. But that's not OPEB. That's not pension cost, right? They are what they are, and the actuaries, God bless them, right? I love numbers. They're like,
So it really
They're
doesn't
like-
cost us money going ahead of it.
not in the, it doesn't save us pension money. It doesn't save us OPEB money. It indirectly could save or cost us money if we were so far out of line. I'll again go back to S&P's write-up of the town of Bloomfield. They mentioned that we have high long-term liabilities, right? Our OPEB funding is low, right? But it's not zero. And we have a plan that we're sticking to, and year over year, we're contributing not the ADEC, but our plan to increase and achieve the ADEC contribution over a period of years.
Okay, thank you.
Darren, our annual comprehensive financial report, if I'm not mistaken, I recall our pension liabilities dropping significantly. Like I'm looking at it now, I think it was like, if I'm not mistaken, like $20 million, if I'm not mistaken. And I think when the actuarial came to one of the meetings, when we were talking about the Board of Education's still open pension plan, which is now closed thanks to negotiations through partners with the Board of Education, the new Board of Education, trying to figure out a plan on how we continue to bring that liability, OPEB and pension liability down. And they were supposed to get me a plan on what we can do to decrease it. I know it may be unpopular with current staff about raising their contribution levels, but we need to look at, because the rating agencies are talking about our long-term liabilities, we need to come up with a plan as to Councilor Mira and start to chip at it, because I think long-term it is gonna cost us significant, and God forbid, if something major happened, we gotta make sure our house is in order. So can we get, I know it's the audit and I know it's the budget, but this is from consultants that we pay. If we can get a plan for them on how we address our long-term liabilities, whether that's putting more money in our OPEB trust.
Yes. That's the first thing they're going to say.
Yeah.
Contribute
yeah,
more.
I know that, but we just.
Contribute more towards the unfunded liability. Other than that, there's tweaking benefits to reduce the cost of those benefits, which I'm not the town attorney, but I believe needs to be negotiated.
Yeah, negotiate through union contracts, but I just would like to see a plan on, like, how we can, as a body, start to attack that long-term liability. We don't want to take collective bargaining away from anybody. We don't want to take benefits away from anybody, but we want to make sure that we're putting the town in a good position to be able to to sustain what we're offering.
Sure.
Because ultimately it's gonna come back to taxpayers.
Yeah, I mean, the work of the actuaries is they look at our prior vested employees, our current employees, the age, the health, and, you know, the expected life of prior employees and current employees, employees that were participating that separate from service. That's what I first think of when you asked earlier about the reduction in our pension liability. Reduction in pension liabilities occur for a variety of reasons, including, as I just mentioned, separation from service. Oh, Daryl's here now. Daryl's going to be here for 20 years, and then he's going to retire, and then he's going to draw benefits. That's what actuaries do. But actuaries don't recognize that after 10 or 15 years, Daryl might leave. So annually, or on a rhythm, be it annually, every 2 years, 3 years, they will update their experience to say, who are your current employees now, right? Have any separated, have any unfortunately, passed on or gone on to glory? All of that impacts the valuation that the actuaries calculate.
Thank you. Any additional questions? If not, okay. Next item on the agenda is the discussion regarding budget development and guidelines. This is basically to figure out how you're doing in the development of the budget, if we're on track to get it done, and
Yes. We have council's calendar with the recommended dates and the not to exceed dates. We are working towards the February 27th recommended date for the manager to submit his proposed fiscal 26 budget. Today is Tuesday, so it must have been last week. There's a little syncing up that we have to do with the Board of Education based on their timeline that may push it into the first week of March. But there are other dates that I believe will require us, the manager, to submit his proposed budget and capital not later than, I think it's the end of the first week or beginning of the second week of March. So there's not too much room in the schedule for us to slide. Departments submitted their roll forward operating budgets today. CIP was submitted week before last. I'd say those two, they're the two biggest pieces. We have our fixed costs and miscellaneous costs that we're working through, and over the next 4 weeks, 5 weeks, through a series of meetings with the manager, departments, as well as hearing from council of any initiatives that you would like the administration to implement and undertake for next fiscal year. Our ask is that those be provided sooner rather than later, so that if the council has initiatives for fiscal 26, that we have the ability not only to receive them and digest them, but work them up into the manager's proposed budget so that they will be part of the conversation. And if included in council's adopted budget, when we hit July 1, we'll be off to the races to implement those initiatives. And if council doesn't have any initiatives, just tell us so, and we will move forward with the manager's recommended or proposed budget without any council initiatives.
thank you. Any questions? Councilor Merritt?
Yeah, I was going to say, the capital budget is where probably those initiatives would be. And I would ask that the councilors get to see, we have what, a 3-year plan or something like that? 5-year plan now. But usually it's a selection of things of what we think, what councilors think is more important to do now rather than later. And I wonder if there's some years we've been able to see that early on and have some input so that it can be help determine what things the town manager wants to put in his budget for capital budget, because that's where usually that's the big change thing. The rest of it's just kind of continuing as is to a great degree. Well, we hope so. But when we're not going to add 10 people here or there or the other place, I hope, not this year. But it'd be nice for us to see your proposed capital budget so we could have some input early on and not get surprised at the end.
Thank you for that, Councilor Merritt. I'll make a few additional comments, but in two buckets, one with regard to the CIP and the other with regard to our approach to developing the operating budget. So process-wise, I, under the manager's direction and working across the town to prepare a recommendation for the manager's consideration. The manager will then do his evaluation with all the conversations that he's having, including those with council, and will arrive at what it is that he's going to propose. From the capital improvement plan perspective, right, we have a 5-year plan. And as I've learned in recent weeks and months, this year and some of the prior years, the direction with regard to capital was inconsistent with best practices. Right? Some departments, if not all, were told not to submit CIP projects because they weren't going to be funded. That is not what a capital improvement program is. Capital improvement program is where we identify the needs across the town, be they in year 1, 2, 3, 4, or 5, and we include them in the CIP. But as council considers the annual budget and the CIP included in that budget, the only thing that council is authorizing for funding is year 1. Years 2 through 5 are planned, right? So I say that because the inclusion of projects, because they are capital needs of the town in years 2 through 5, they are not being approved for funding. Only the first year is approved for funding. So in the evaluation of the CIP, both at the proposed and the adopted level, that's just a fundamental understanding that the council is not authorizing expenditures for the entire 5 years. It's only 1 year at a time. And then we have the ability annually, if there is a need, let's say that for this year was in year 2, we can bring that forward to year 1, or we can decide we want to continue to wait and keep it in year 2, right? But the projects need to be there for visibility, not only internally in the administration, but forward facing. So I'll give another hypothetical. There's a project that's shown in year 5, and then we do a new budget and it's in 4, and we do a new budget and it's in 3, and we do a new budget and it's in 2. And we do the next budget, it's supposed to be in 1, and we delay it. And let's say we delay it for 3, 4, 5 years, and then something goes bump in the middle of the night, right? The part of the administration's work is identifying those capital needs. The council is the only one that can appropriate. So if council doesn't authorize expenditures for the project, we cannot do it. That doesn't mean the capital need doesn't exist. So we still need it there for visibility, so that if something goes bump in the night, we can point to it and say, we've been trying to get this done for years. Now we actually have to do it. And doing things under duress because they went bump in the middle of the night tends to be significantly more expensive than doing it as part of a plan. On the operating side, the approach to developing the recommendation for the town manager's consideration is very simply this. We're going to roll forward our fiscal 25 budget, status quo. All of the services that we're providing, the staff, everything that we're doing in 25, we roll that forward to get the benchmark. That's the first benchmark from the budget process. It says, what would it cost? So in light of the reval and the reval mill rate, then we look at what would we need to raise the mill rate for status quo, right? So that's the first look, and we're, again, over the next 4 weeks, we'll have that information. And then from there, we're looking at the 2 buckets of our operating cost. There are things that we have to do, right? We can't eliminate. We have to pick up trash. And not only do we have to pick up trash, we have to pick it up every week, right? Vector control, right?
No, we don't. I mean, some people said we can drop that and lower the budget.
Who said that?
People that didn't want to get reelected.
I would refer anyone to, I believe it's the State Health Department for vector control, right? That weekly pickup of trash is required because, as I learned a couple decades ago, the gestation period for a maggot.
Winter doesn't
1
pick
week.
up trash. They depend on private companies to do it.
So do we. We have a contract. We don't pick
Yeah,
it
I
up.
know, but it comes through our budget. Winters doesn't.
So I'm not talking about who picks up the trash.
Okay.
I'm talking that the trash has to be picked up. That's a mandated service. And in this description of our process for the development of my recommendation to the manager for the proposed budget for next year, in our operating budget, we have things that are mandated. We can't change. We might be able to tweak the service level a little bit to try and capture some cost, but we have to do those things. The other side of the operating budget, the other side from mandated, are discretionary. And then there's the discretionary things in our budget. Those tend to be the feel-good things, the things we want to provide our residents and businesses. Those we have full discretion over. So as we roll forward the 25 budget, the fiscal 2025 budget into the fiscal 2026 budget development, roll it forward status quo. We're going to keep doing next year the same thing we're doing this year. But then once we have that cost, we look at what we might need to cut to get to an acceptable mill rate. And that's where the difficult decisions come, not only for the manager and his proposed budget, but for the council and their adopted budget. Because what I can't say as of now, because we're just due today, the operating submissions by departments, is what that new level is of roll forward. As Councilor McCleary pointed out earlier, we know that our contracts, even though they expire June 30th, the current contracts include an increase of 2.5%. We know that debt service is going up $1 million. We know that insurance goes up single digit, sometimes double digit. Fuel, right? All of the things that go up, that's the roll forward, status quo. And then we figure out what, if anything, we need to cut, either partially or totally, to arrive at that acceptable mill rate. And I do believe that the manager is going to submit a proposed budget that communicates well what's in the budget, what's not in the budget, and all of the components, right? What each department does. We'll look at debt service. We'll have it all laid out so that the document itself will be our communication device. We may have questions from it, that's natural, but the document should do a very good job of communicating what and why each dollar that is included in the manager's proposed budget.
Thank you. Any other questions? Thank you. Financials.
Right, to this month, November and December, of course, I'll do November 1st. This is the 5th period of the fiscal year, or the 5th month.
Mr. Hill, is these actuals? Because I know the last couple of ones you were still trying to figure out where we were.
These are actuals. What I believe you're referencing are the encumbrances.
Yes.
The encumbrances are still not in there, right? I do expect I'll have them for January, at least an initial look with a higher level of confidence than these prior months. That's in part because across the administration, we're doing a better job of actually entering purchase orders to encumber funds for contracts and dollars that we know are going to be spent this year. That's not only important just every day to utilize Munis as our system of record and have that be the source of truth when anybody has a question, not a spreadsheet or what is in somebody's head. But for November and December, in the expenditures detail, that estimated to be spent and encumbered is, I believe, the line you're referring to, but what it reflects now is our actuals. So for November 24, again, the 5th period of fiscal '25. Our revenues came in at 60, we're at 64.2%. And actually, counselors, I can go through November and then go through December, or because they are fairly close to each other, I can kind of string them together, or you want me to do them?
Just do December, because that's the most, just December, because it's the most relevant. We have this for our information purposes,
So for,
which I do want to compare to December, but
and I actually correct myself because, and there's probably folks on home that know that I was referring to November as the 5th period, when November is the 5th and December is the 6th, halfway through the year after December. So for December 2024, the 6th period of fiscal '24, revenues are at 64.5%, slightly lower, about 3 percentage points lower than the same period last year, with our tax collection at 65.1%. That hasn't changed all that much, and I think it only changed by about $20,000 from November, but it's about 5 percentage points lower than the same period last fiscal year. But as we're in January, I know our tax collector, Mrs. Jesus, is collecting the second half of what is roughly $50 million. Interest income continues to be lower than the prior year. Last year was a high watermark at over $1 million, but we are sitting at $717,000 of interest income through 6 months of the fiscal year. If that were to hold, we would be approaching 1.4 million in interest income for the fiscal year. That does not mean that I expect it to hold. Building permits and demolition is up at 817,000, trailing last year. But I do anticipate seeing a slight uptick in that for the January financials. And our real estate conveyance is outperforming the prior year at just over $400,000, or 67.4% of budget, which is 130+ thousand higher than the same period last year. And our expenditures through the 6th period are at 34.6% of budget, with the revenue detail on the next page. Be sure at the top it says FY 2025 as of 12/31, as opposed to 11/30. Make sure you're looking at December. Our tax and assessments are at 64.5% of budget at just over $62 million, with total revenues just over $71 million. With expenditures against that 71 million of $38 million, or 34.6% of the budget. Our expenditures, of course, led naturally by our Board of Education, just under 15.5 million through 6 months, followed by our fixed charges, where insurance and benefits are at just under 5.5 million, and public safety at 5.2 million.
quick question. Is overtime driving the increase from month to month with the police department? Because in November, lease was at like they were at like 3.8 million, and now they're like 5.2 million. So that was what, $1.3 million? If I'm not mistaken. Increase from month to month. And so what's driving that?
I'd have to drill down and get that answer for you. I will have it for you at next month's meeting.
Sorry, I just want to know what's driving the increase and if it's overtime. Because usually the police does a really good job at giving us money back. So I just want to make sure that we're on track to continue that precedent.
They're spending $1 million less.
Yeah, I know, but still, it's still up. And then my other question, Mr. Hill, is for the life of me, could not understand why, if you look at previous year's budgets, we were very conservative on what we put in the budget for use of assets. And in this body, with the former deputy mayor, Mr. Davis, and I advocated really, really long and hard to reshift some of our use of assets and where they housed, and we put it in the treasury, and we saw an increase. And I guess staff at the time got really excited because they saw that as additional revenues. And I really argued tooth and nail against increasing that use of asset number in the budget, because I knew that use of asset was driven by the market, and you want to use one-time revenues, one-time revenues in the budget as just that, one-time revenues. Because if we don't hit that number that's budgeted, which I don't foresee us not doing, but we never know with this market and with the geopolitical stuff that's going on in this country and internationally, what would happen with interest rates in the market. Are we projecting to bring that use of asset down? Granted, if we bring it down, we have to find money somewhere else to replace it, since we put it in the budget as what, 1.2 million dollars? When
Yeah, about that.
before it was like between $200,000 and $300,000.
It's a very dangerous practice.
Yeah, I fought against it, and I was looked at as being a troublemaker for that. And I'm going to continue to be loud about it. I thought it was a mistake then, and I still think it's a mistake now. And moving forward, I would like to correct that.
Yeah, I mean, that interest income or use of assets line is an easy place to be a target, good and bad. From experience, the best practice is to be conservative. As I've said before, I have a crystal ball and it's always cloudy. We're trying to not predict, but estimate what interest rates are going to do over the next 15 months, right? 15 months, not 12, because of the budget development process. That's several months in this fiscal year. So to arrive at what that estimate would be, we'll be utilizing a variety of sources, not the least of which is the Federal Reserve's projection for the coming 12, 24 months. I'll look at the Congressional Budget Office, without mentioning any other names. We'll look at a variety of sources and formulate our own opinion about what we think is going to happen, and then we'll crunch the numbers to arrive at an estimate. And then we will take that estimate and back off it to make it conservative, so that we'd be looking similar to this year. I'm not suggesting the $1 million, but I'm suggesting that halfway through the year, we've already captured 71% of the budget. So save, some, knock on wood, disaster in the last 5+ months of the year. And I'm not talking about in Bloomfield, I'm talking about the general economy that would impact interest rates. We are going to not only meet, but will exceed the budget for this year. Now, trying to do that on an annual basis is difficult. We've been on the uptick or upstroke with regard to interest rates coming out of the pandemic and the stock market doing well and a variety of things, So at some point, there's always a correction.
Oh, yeah.
And trying to avoid that correction is the real art.
Yeah, I saw it then as like, okay, we bring in it this and we're very conservative. Again, put the extra, if it's over, fund balance, you're not depending on that. That's something extra that you have. Support support infrastructure. We know we have tons of infrastructure needs. If you have extra, you put it towards infrastructure. You don't put it in the budget, because then if you don't get it, then what do? We find ourselves using fund balance anyway, because if we run a deficit doing fourth quarter transfers, we will auto correct it, right? And so you want to just be mindful of that. And so I'm happy you are keeping an eye on that. Councilor Mary.
Now, can I point out that the Board of Ed, after the first 6 months last year, had spent 19 million, yes. And this year it says 15 million, so, this year. So that sounds pretty optimistic, but I think it was pointed out to us that Munis is not giving us 100% information on these sheets. Is that still true?
Well, it's not Munis.
We're now onto Munis. This is Munis.
It's
Or the board
it's
is
like in the accounting world, we call it FIFO or LIFO, first in, first out, or last in, last out. in technology, they have GIGO, if you haven't heard that before, anyone? Garbage in, garbage out, right? So if you put bad information in a system, you're going to get bad information out of it. Not suggesting that that's what's going on with Munis and the Board of Education at all. It's more of, as I've been speaking to in over the months, the information is not even getting to Munis. It's in a spreadsheet.
Yeah.
And then at
It isn't
an
here.
interval, that spreadsheet gets processed through and then finally gets to finance to be entered. That's the prior practice. What we're migrating the town to now is entering the information in Munis. You know, it doesn't have to be immediately, although that would be preferred, particularly when a payment goes out, but within, 24, 48 hours. So that it's not, well, anyone, me included, can look in Munis and expect to see where we are. That's, as Councilor McCleary mentioned earlier about encumbrances. We're increasing the use of purchase orders, which is how money's getting encumbered, which is why I'm starting to feel better about what the encumbrance numbers will show when I get to the January report. If the information is not in Munis, I can't report it.
But-
I'm not doing what I saw. I'm not continuing prior practices.
Quick question.
This is more credible than it was last year? Or six-
Last year,
Yeah,
I have no idea. I wasn't here.
okay, but, last, 6 months ago then.
Yes,
We're doing better and better with this.
every month, we're doing better and better.
Because of internal policies, right, that you've established with people submitting requisitions so that you can do is that a part of your plan, corrective action plan for the audit? Making sure that you know what's being spent, when it's being spent, creating practices of reconciling monthly? Are you I know you've incorporated, based on our conversation, some of that with the town staff. Have you talked to your counterparts, not, again, preference this, not blaming the Board of Education, because they've been very good partners over the last couple of months with the town, and the town manager has a very good line communications with the new superintendent. I assume you have a very good line of communication with Dominic over there, so not this next statement preferencing, not blaming the Board of Education. But in the past, they would then send incumbents like 6 months, 4 months late, and then 1 month we'll get this update and we'll just see a huge balloon of that year-to-date number on this sheet because they are kind of late in getting you the information. Are you comfortable with this $15 million versus 19? So that's almost a $3.5, $4 million difference from year to date?
Yeah, I'll say this. Trying to compare year-over-year budgets is only for reference, right? To really not know what's going on and why the same period last year was at 19 million, we'd need to dig down into 6 months worth of disbursements to see where it is. It may have simply been that they paid an insurance payment a month earlier, and when last year they paid a month, right? So it's irrelevant, right? But the Board of Ed is on board, right? Folks inside the administration know, one, that I'm very philosophical in approach to the work, but that we have a capitalized P and a lowercase p when we refer to policies. I think you're talking about a lowercase p. I've not issued any policies. I've issued directives, and my directives have been to comply with existing town policies and best practices.
That's a
And that in and of itself is what we're doing and where we're going. And whether it's the Board of Ed in general or conversations with Mr. Greco, we're all rowing in the same direction.
But that's good to hear. Any additional questions for members of the committee? I just preference, I think this right here also helps us forecast, and we know that it's projections and it's subject to change, but this helps us forecast where we believe we're going to be at the end of the year for fund balance. And as we go into budget, we know, okay, based on these monthly statements that you provide us, updates, we are going to be able to project that we are moving towards having X amount to roll over to fund balance. And, one year, we didn't know where our fund balance was going to be, and we raised taxes 6.5% because we didn't know that, right? And then they came back 2-3 months later, said we found $5 million. You ain't found $5 million. You just didn't have an accurate count of where we were from encumbrance and the spend number, et cetera.
Well, and I would even suggest more than that, right? Knowing,
True cost of government.
knowing where the town was with the audit of fiscal 2023 during budget development. The question is, did you have a good number for
We
where,
didn't.
for where you ended 23? So let's talk about where we are now, past the past, right? Where we are now is, while it may not be February, we're looking at March to finish the audit, which is not June or July, right? We'll know where we're gonna finish fiscal 24 and what the impact on our reserves will be while we're in budget, right? That coupled with this information that will be 2 more months long, right? I think we'll have pretty solid information to make well-informed decisions on.
I appreciate that because I think during this budget season, we have to figure out what the true cost to run this government is. And I know it's all a projection, but I want to get fiscally conservativeness, Councilor Mary, try to get as accurate as possible to what the true cost of it is to run this government so that we're not overburdening people with taxes that we don't have to, because it's rough. It's still rough out there. On paper, it says that the economy is doing well, but the reality of it,
Yeah.
it's rough. And I know it. I talk to my neighbors,
Believe me, I
to
know.
friends and other young people in this community. Some of us on this body are 1 or 2 paychecks away from not being able to afford to live here. And so we really have to get the true cost of government and try to streamline where we can so that we're not putting this burden on residential, Bloomfield residents and our commercial space, so that we can continue to promote economic development and that people can live, work, and play here. And so over the next couple of months, I want to get that true cost of government as close as possible. And I know you hear me say this all the time.
Yeah, oh yeah, I know. I mean, I've got 2 young adults in college, and
Gee,
God willing, they'll graduate this May, and I'll get a little bit of a tuition raise so I can have sushi more often. Yes, I mean, so I'll make this my last comment unless you have additional questions on the budget. Yes, no one wants to overburden our taxpayers. But in the budget process, you've heard me say it's our most important document of the year. It's where we identify our priorities by funding those priorities. And while that's a very strong soundbite, the reality is it's where we get to determine what type of town we want, right? Through the services we provide and the services we don't provide. So one way of looking at it is, how much are my taxes going to be? Another way of looking at it is, what services am I getting for my taxes? And if I want my taxes to be lower, you're going to get less service. It's just the way the world works. Nothing is free.
but you have to show the residents where the services are, right?
Absolutely. That's
They
why the
can't- I say it all
budget
the time
document
to-
is so important to communicate.
Yeah, I say it to most of my colleagues up here, if they can't see it or feel it, it doesn't mean that it happens in their eyes, quite frankly. And so we have to do a better job of letting them see it and feeling it. And so things like this, and why the audit is so important to be on time so that they can see it and then they can relate to feeling it. And so I'll get off my soapbox, because over the next couple of months, I'm gonna be very micro and macro focus on trying to get this to the true cost of what it runs for government. And the same thing with the Board of Ed. What is the true cost to really run that Board of Education, the education system in Bloomfield, so that people see their return on their investment? And so.
Looking forward to a robust conversation through budget development of questions and answers.
Great, perfect. Any other questions for Mr. Hill? Hearing none, next item on the agenda is public comment.
Thank you, counselors.
Thanks. Please raise your virtual hand. You have 3 minutes. Is there any public comments? Just one time. Is there any public comments? Going twice? Is there any public comment? 3 times. And for the final time, is there any public comment? Seeing none, we will move now to the approval of the October 21st minutes. Moved by Councilor Merritt. Is there a second? Seconded by Deputy Mayor. Any discussion, any edits? Seeing none, all those in favor say aye.
Aye.
Aye. Minutes pass. Now we'll move on to the November 18th minutes of the Finance. Moved by Councilor Merritt, seconded by Councilor Waterhouse and Deputy Mayor Harrington. Any discussions or edits? Hearing none. All those in favor signify by saying aye.
Aye.
Opposed have the same right. Motion pass. Thank you, Mr. Hill. Thank you, Donna. Thank you, Mr. Town Manager, for your work. If there's anything that this committee can do to assist you and providing resources to you, we would appreciate that, letting us know, and we'll be happy to oblige. Motion to adjourn.
So moved.
Seconded by Council Waterhouse. Have a good evening.